right, well, with things beginning to look up a bit on Wall Street this midday, we wanted to talk to financial strategist Clark Hodges. He's here to give you some in-depth analysis, and we know, Clark, with stocks on the upward trend, it's not necessarily surprising. You had said whenever we see the market drop a certain number of percentage points, the next day you're going to see people jump into the market.
Yeah, on average, statistically, about a 6 or a 5% drop. The next day, average is up to 2.5%. So it's not out of the question that this is going on today.
If memory serves, when we go back to 2008, although, as Melanie Hobson pointed out there, the environments are very different. But in terms of the volatility in the market, we saw it drop as much as 900 points one day, up 500 the next, down 300 the next. So it's possible we could see with day trading and so forth, the numbers go back down again tomorrow.
Yeah, you could definitely see a down day tomorrow. I think at the month of August, you could also see a lot of down days and a lot of high volatile days because August traditionally is a slow month. And what that means is there's a lot of people on vacation. So the buyers are kind of absent. The sellers are always there.
What are we expecting this afternoon when the Federal Reserve comes out to provide assurance? We've seen in the past when their intention is to provide some sort of assurance, people still get freaked out and we don't necessarily see the markets go up. So when Ben Bernanke speaks this afternoon, 1:15 our time, what are we expecting?
It's a regular scheduled meeting, so we don't expect him to comment on this current down move in the market. So it's just probably going to be a regular policy statement that he puts out.
But however, that policy statement, reading between the lines, will for some investors give them some sense of confidence moving forward or not.
Yeah, that could be something that triggers a sell-off actually later in the afternoon, or increase the buy pressure to go back up.
Okay, so in terms of where to put your money now, I mean, has the gold train left the station? If you put money in gold the spring of '09, you've seen it triple almost.
Yeah, if you follow the buy low, sell high, if you buy gold now, I think you're buying high.
Right. It could down. So you think you're saving yourself, and you see that take a downward trend.
If you look at the market, a lot of people are comparing this to '08, and it's not '08. Companies are in much better position. So think about blue chip type companies that pay a dividend. So you buy the blue chip, it's got a better dividend than it had 10 days ago.
Now, if you're looking at a portfolio, this is the last question, you're looking at a portfolio and you see that somebody's taken a slight loss on something over here, but now there's a buy opportunity over here. Are you taking that loss here and hoping to get a gain over here? Are you shifting things around within the portfolio in this environment rather than getting out altogether?
In my opinion, only sell a stock that you have lost faith in because of what the business is doing, not what the market is doing.
And not what other people are doing with it.
If you like it, stay with it, maybe add more. Put about a quarter to a third of any fresh cash in the market now. Wait a couple months, ease back into it. But the smart money's buying today. The smart money bought yesterday.
So that person who's continuing to put money in their 401k this week, they're buying into this market.
You bet.
Which over the long term is going to go up.
They're buying on the low side, and that's good.
All right. Thank you, Clark.
You bet.
Appreciate it. Clark Hodges, always nice to have you here, and keep it right here for continuing coverage of the markets.